Let's turn now to Smart Charts with Abigail Doolittle, where we look at timely topics through the charts. And this week, Abigail, you are taking a look at whether stocks have gone too far, too fast, a frequent criticism.
Indeed it is, Scarlett. It's hard to ignore, especially when you're looking at the technicals. And to do just that is Todd Sohn of Strategas Research. Thank you for joining, Todd. It's great to have you here. And it really is amazing. Chart after chart, it just seems like there's a huge amount of movement above the various moving averages. Let's start out with your S&P 500 chart here.
Yeah, so this is the one chart here that gives us a little bit of caution. You have fresh highs for the S&P today, but internally, momentum has actually started to contract.
Yeah, these RSIs are worrisome, right?
The RSI, which is a momentum indicator, has started to diverge to an extent, right? Lower highs, as you can see on this chart down here. So this just leaves us on our toes a little bit that tactically, maybe we should raise our stops depending on where we are long. If you do get a pullback, look towards 3,200. Initially, that's the 50-day average, roughly. If something worse is brewing, we're looking at more 30.30 to 30.50. That's a more significant correction there.
And when you have a bearish divergence of this nature, does that typically mean that it will feel more like a real correction because it will happen very quickly, or more of a gentle pullback?
I think it can be more severe once the catalyst gets rolling here. Now, divergences can persist, so we don't want to get ahead of ourselves, but when they do finally unfold, it's fast,
very quickly.
it's swift.
That escalator up or stairs up and elevator down, although it's definitely the escalator at this point up and then possibly that elevator down.
Absolutely.
Let's now take a look at perhaps even bigger message along these lines with the NASDAQ 100.
So there's two ways of looking at this chart, right? It's the NASDAQ 100 and the bottom panel is how far away from its 200-day average is it? We're at about 20% right now.
Unbelievable.
Super impressive. Now, historically, when you do get this far away, it's actually bullish roughly 6 to 12 months forward because the momentum is so overwhelming. But tactically, again, I want to be on my toes here. This is very extended. We should be on watch here for any sort of pullback over the coming weeks. That's a pullback we're going to want to buy given the momentum characteristics here. But again, stay on your toes until something unfolds here.
And if something were to unfold to the downside, back down to that 200-day moving average or a little bit less?
I don't think you do much worse than 200-day, even if we get there.
Okay.
Right? Even on the S&P, let's look at the 50-day first.
Right.
That was as worst we did last 2 weeks ago.
So unlikely a 2018 event, but maybe just a healthy.
Yeah, I think just a little pullback here. It's going to hurt in some stocks, but momentum like this is not consistent with a big top. It's more just short-term mean reverting. As
you were mentioning, some tactical trading opportunities for those who are very nimble. And then finally, if we bring credit spreads into the picture with the S&P 500 and also the consumer staples base.
So if we're going to see a bigger pullback, it's interesting that our risk appetite barometers actually haven't really shown it yet. On the bottom panel here is consumer staples versus the S&P inverted, and credit spreads inverted as well. So you're seeing the S&P break out relative to staples and a tighter credit backdrop. Both of those are just not consistent with a major top forming. They're actually more supportive of increased risk appetite and higher equity prices. If this is going to reverse, you'll probably see it in credit. You'll start to see staples subtly outperform, but that's just not the case here yet.
So keep an eye on those credit spreads as a possible tell for the idea that stocks could start to roll over.
Big corrections happen when credit starts to deteriorate, and we're not seeing that just yet.